Good morning, everybody, and happy Wednesday. We just had a CPI report. Obviously, markets reacting quite violently. We will look at all this here in just a few minutes, actually a couple of minutes, I should say, in about 2 minutes past the top of the hour. If you guys can hear me okay, please let us know how the audio and visual is working for you. And then we should be ready to get started here in just a minute or two. As always, please give us a thumbs up, like, and subscribe to the channel. That allows us to continue to do these morning shows and give you the most value possible as far as analysis of the markets go here on an ongoing basis. So we'll get started here in just a minute or two. If you guys have any questions in the meantime before we get started, obviously please give us a message in the chat box so that we can address them here through our morning show. Alrighty. Sounds like audio and visual is good, so thank you for participating in the test. All right. Very good. Okay. Perfect. I think we should be ready to get started here in a second. Okay. All right, very good. Again, good morning, everybody. Welcome to our Set the Market Morning Show. Serge Berger here from The Steady Trader. If you're here for the first time, as I always say, welcome. This is meant to be a 10 to 15 minute sort of look at what's top of mind for us, what we think are some of the most important things here to look at from a trading and investing perspective. And so please do make sure that you subscribe to the channel because it allows you to be updated in real time right here through YouTube when we go live. We typically will go live also through other big events as well, in addition to the morning show. And also please give us a thumbs up like. So let's get started. Sounds like audio and visual is good. What's going on here? I mean, obviously the big thing here this morning is the rally in risk assets, the sell-off in yields, and we need to kind of make a little bit of sense of it. One thing I'll say, and this is not obviously yet to be something we can determine, but oftentimes the first reaction to a report like this is not the right reaction, or not the reaction that ultimately sticks. So for like right now, if that were to hold true, and I don't have any sort of meaningful sort of bets in this direction by any especially that imagination, this here is the S&P 500 futures contract. I'm showing you the futures because obviously the equity market, U.S. equity market, is not yet open here. It opens 25 minutes or so. And so what you can see here is the overnight session in this gray or brown area, whatever it is. Gray area. And then, of course, we had that big spike. And what's happening right now on our Vertical X Pro indicator is that the S&P futures are getting severely overbought on the 5-minute chart. So that may be for 30 minutes, an hour, 2 hours. We'll see, right? It's just an intraday signal. I suggest anyone here that wants to be a trader and investor that you have a process and a tool that measures when something is extremely overbought or extremely oversold in the near term, because it also allows you to gauge better what might be happening through the lens of a multi-day, multi-week time frame. Because you're going to find these pressure points in the markets. And I think we have reached here a short-term pressure point on the upside. It's certainly possible that when the cash market opens, we get a few more algos kicking in and pushing it somewhat higher. But I would not be surprised if we're going to start basing here and either have a really boring day where things just go sideways and we wait until the election. That's possible. Or we literally give it all up and things start coming back down. I don't know which it is. We'll have to find out. I don't have a crystal ball. But I do know that according to my indicators, at least, the Vertical X Pro indicator, we're very short-term overbought. I mean, again, this is literally a 5-minute chart. So this does not mean that things have to fall apart. It just means that for the next 30 minutes, maybe a few hours, we're probably going to start stalling somewhat. again, just to be clear, it doesn't mean we have to fall apart. It just means that we're probably going to not continue to go rally at the rate at which it has. In fact, it's nearly impossible to rally at the rate at which it has since that big spike came. I think the S&P rallied about 120 basis points, so 1.2% on the back of, or maybe not quite, maybe a bit less, on the back of the CPI report. So that's something, and if you're a Vertical X Pro member, you can go check the chat room. That's where I posted this, and I will be updating this chart throughout the day to see how this trade setup here is going to progress. Now, at the same time, of course, we do need to keep in mind, this is the big picture CPI inflation breakout. Inflation is still going higher. It's re-accelerating. Just because it came in a little bit, better than what people feared, and the algos are very quick to react, doesn't mean that CPI isn't back on the way somewhat higher. This is the long-term picture. This is the multi-year picture. That's really what I want to keep in mind. And again, inflation expectations, which we talked about. This is from the Bloomberg terminal. But if I show you inflation expectations, the chart for that is here. Quickly bring that one up. You can see here too the inflation expectations, which I believe I showed this chart yesterday. It's all the same, are breaking out. That doesn't mean in the near term we can't have the market get excited about maybe baking in more rate cuts, but that's kind of the trend in the bigger picture sense. So I wouldn't want to lose sight of that. 10-year yields, which is reflecting exactly what I just showed you for in the equity market. So 10-year yields are coming back down. So 10-year yields are now basically back to where they were on January 7th. That is yesterday, 1 week ago yesterday. And we're now, just shy of 4.7%. So, the trajectory here is still very clearly higher. So I'm not sure I don't think this is a trend change in yields. I think this is more a quick reaction to algorithms. Again, you have to think about this, like a human being can't react that quick. These are algos that read the headline and immediately react. So the algos may only have a time frame over the next hour or two. They couldn't care less. So this is not human beings that are pushing these futures higher. So that's why I'm saying we have to be open to the outcome here. Let me know if you guys have any questions on that, or if that makes sense, or if you have anything else that we can address for you on that. Now, we've talked about this. I want to talk about earnings because we this morning had earnings from JP Morgan, Goldman, and Citigroup. And when we use our trend work, we notice that the financial sector, so the sector that's of the S&P 500 that represents the financial stocks, the XLF ETF is what it is. It has been in a bullish trend since November 2023. So, a year and a quarter ago is when that went bullish trend. So there's nothing new here. What we could see though, and this is something again we have to be open-minded to, is a next move higher. So if I adhere to this signal back in November 23, I'm now up 41% on this trade. It was up as much as 52%. What's possible now, if I go on the chart, is that if I look at individual stocks within this sector, so you look at Goldman Sachs, also in a bullish trend. It was in a bearish trend, went to a neutral trend, and it became a bullish trend in December of 2023. It's now up 65% since then. And all I have to do is respect the trend. It's really not any, rocket science. JP Morgan, it was in a bearish trend, then went to neutral, and then finally a bullish trend in February of last year. So about, let's call it 11 months ago, and that stock is up 40% since then. So the question we have to ask ourselves is, what's the next move? Are we going to continue a breakout higher out of this consolidation phase, or is it going to be just a sideways consolidation? I don't know, but I do know the trend remains sideways, higher, excuse me. So if I want to now see if there's a trade setting up, this is again more on the very near term part. Let's first have a look at like the XLF. So this is the chart I just showed you on our market rover. Again, the bullish trend remains intact. So is it possible that we now see a next leg higher, a continuation of this trend? I would say if XLF breaks above, 49 and change, then that could be a next leg higher in the stock, in the financials as a sector. You have to keep in mind, though, that the financials as a sector are not just banks. There's also insurance companies in there and all sorts of things like that. Insurance stocks have actually come under pressure quite a bit due to the fires in LA and some other factors at work there. So I wouldn't want to get too excited about the financials as a sector just yet. I'd like to see from a trading perspective, from an investment perspective, the trend remains bullish. So there's nothing concerning there. From a trading perspective, what I personally want to see is I want to see the XLF hold above, ideally maybe about 49.30, 49, around that area. And because I think if we were to see that, then we could see new momentum coming in. Our momentum work, which is the TSD Trender indicator, has the financials, the XLF, actually not in a bullish momentum trade yet. So I'm waiting for this to kick in. That'll then confirm itself on the actual charts. And of course, on the market rover, our trend work, the trend is there. So we have one confirmation. We now need momentum confirmation. Again, if you guys have any questions, please let me know. Very happy to address anything around there. So that gets me to JP Morgan and to Goldman Sachs. So JP Morgan is my alma mater. I watch that stock very closely. What I do know is that typically after earnings, the stock will tend to consolidate after the rally. So you look at, for example, and it's not always true, but let's just go look at last year, for example. So last year, the stock rallied into earnings in July, and then it basically consolidated. It did the same thing in October. It rallied into earnings and then it consolidated, right? For at least typically, my time frame on these things is usually about a week or two. And again, we'll see what happens here today. We don't know yet, but I wouldn't be surprised if we see a similar reaction. Again, the stock has rallied into earnings. Again, watch this. The stock tends to rally into earnings, right? It rallies into earnings and then it consolidates. It's now rallied into earnings. And now the question is, what's it going to do? Is it going to consolidate sideways, which is most likely the case, or maybe even pull lower a little bit? Again, we're talking about a 1 to 2 week time frame. After that, we need to see what happens again on the big picture chart, the financials. So that's how I like to approach the market from a, it's very much a process. And I think what we're going to see this year with the year of the trader, or a trader's market, as I keep referring to it, I think this year we're going to see an absolute, it's going to be a requirement for investors and traders to actually have a process, as opposed to saying, oh, the stock is down 5% or the S&P is down 5%, let's buy it. I think that era is over. And because what's happening now is the bond market is dictating what the stock market's doing. And you saw that again earlier when I showed you the chart of the yields and the effect that yields had on the equity futures this morning, which again was higher. In the near term, let's quickly go to the SPY, which is something that we continue to point out. I mentioned this in the second half, just at the tail end of the year, I think December 30th. And then again, as we came into the first few days of the trading year, the calendar year. And I still think on the SPY, that 580 level on a daily closing basis is important to hold. We've held it now since December 20th. December 20th was an important day because it was post-Fed. It's when the market found support and it then rallied and had that basically failed Santa Claus rally. This morning, the SPY is going to, set to open somewhere in this vicinity. So, we need to see. There's really nothing bearish here in any meaningful way in the SPY, in my view, for more than a day trade, unless we break below 580 on a daily closing basis. In case that happens, or if and when that happens, it'll probably also come happen at the same time when Microsoft breaks its support level. Microsoft came very close yesterday to break support after they started to say that they're going to start freeze hiring. I think they have 60,000 employees or something like that globally. They're going to freeze hiring. That was not too well received. And then, of course, the market bounced into the end of the day because algos wanted to be bullishly positioned into CPI, which makes sense, all else being equal. That's a higher bet, a better bet than not. Same thing for Apple, by the way. Again, it's all the same trade is at support. And last but not least, the big one that I think is going to be the one that just matters from an algo perspective and from a fund flow perspective, it's NVIDIA. At the end of the day, whenever this stock if and when, right, I'm not trying to make forecasts even, but if the stock starts to consolidate and go into a longer consolidation phase, and starts to crack a little bit, that there's going to be a lot of money that flows into other sectors out of NVIDIA. There's so much money in that one stock. It's going to find a home somewhere, whether that's healthcare, energy, and a lot of people are not going to participate in that because they're so sold on the NVIDIA story, number one, that they're going to be, not knowing what to do when the stock doesn't go up anymore. And number two, energy and healthcare just isn't that sexy for people. No one cares. On the retail side, institutional investors, of course, have a bit more of a broader perspective. And I should also say, and again, this is just to piss off the perma bulls on NVIDIA. I'm kidding. NVIDIA is at the same level it was in June now, right? It hasn't done anything. That's just where it is now. Does that mean the stock can't ever go higher again? Of course not. It's a great story. It's a great bull story. But just keep in mind that stocks can go sideways for a long period of time. Even these great bull stories. And that's what I'm trying to explain to people. It's not about the fundamentals at this point anymore, in my view. It's about the crowding of that trade. And when the earnings growth starts to stall a little bit, like the rate of change, not the actual growth, like it's still growing, right? But the rate of change starts to slow down, you can get a situation where the stock ends up essentially consolidating, right? Be that sideways or to the downside. Either way, it's people are not going to know what to do because they're just kind of like, oh, it's no longer going up. So that becomes a thing. Meanwhile, again, if you are watching the pre-market activity here, like I said before, this is what's going on here right now. I'll end with this. S&P futures, again, they're still vertical X pro indicator overbought, meaning they're severely overbought here in the 5-minute chart. Again, this is more of a multi-hour indicator as opposed to anything beyond that. But watch this. It's in the chat room, and I will update you guys if you're using the Vertical X Pro in the Vertical X Pro chat room on that. So that's it, folks. Have a great day. We'll see you guys back here tomorrow morning, Thursday, for Set the Market. Any questions, please let us know. And please do hit the subscribe button. It's very important. It helps you be alerted in real time when we go live. And also give us a thumbs up like so we can continue to do this morning show. See you soon and good luck out there today.